I'm a portfolio manager with Fidelity Investments on the Hedged Equity Solutions team. We're developing strategies that seek to provide equity investors that don't have the risk tolerance for downside risk and spikes in market volatility to protect themselves from those drawdown events. So this suite of solutions is aimed at risk-aware investors that still seek capital appreciation. So what's unique about our approach to hedged equity is really three topics I'd like to identify. First and foremost, the corner of our strategy is diversification of positioning and liquidity. So we could have the most potent hedge in the world. If we can't trade it during periods of market stress, it does us no good. So S&P 500 listed put options are as illiquid of a security type as I know about. That's the tool that we use. The second cornerstone is diversification. So instead of holding just one or two option positions in the portfolio, we hold a minimum of 6. Those positions are diversified across expiration dates. So we always have 6 different expiries and we always have 6 different strike prices. That allows us to hedge a broader spectrum of downside risks, and it allows us to take some of the market timing element of expiring options out of the portfolio. A second interesting attribute of our approach is that we actively manage the option positions. So instead of buying a put and sitting on it for 2 or 3 months and not trading it, we're always trading at least a third of our portfolio on a monthly basis, sometimes 2 or 3 times a month. And that allows us to, for one, keep the portfolio in tune with the rapidly changing risk dynamics of the equity markets. And 2, in an open-end format, as we have investors come and go, we need to ensure that we're doing everything we can to give new investors comparable risk attributes. So regardless of whether you join on day 1 of the month, day 45 of the quarter, the risk attributes of the hedge are going to be as equivalent as we can achieve. The final component I'd like to talk about is that we deploy an explicit cost model. So we're spending cash to buy our put protection. We have a maximum annual budget, and we think that this gives us a more straightforward approach to downside defensiveness. An alternative to our approach is to sell call options to fund or to defray the cost of our long puts. Anytime you sell a call option and trade for that cash that you bring in, you introduce opportunity risk, upside risk for the equity portfolio. So as equity managers, we're laser focused on managing that left tail exposure. And so we want to hedge the downside risk, but we want to capture all of the equity upside. So we do not want to introduce any upside hedging, any upside truncation. So that's why we structured the hedge in that way with those attributes.